Investing is the art of planting trees. Trading is the art of navigating storms. One asks you to wait, the other asks you to act. Both demand discipline, but of different kinds. When people first encounter financial markets, the words investing and trading often blur together. They both involve putting money at risk, analyzing assets, and aiming for profit. But beneath the surface, they represent two radically different philosophies of how to engage with uncertainty. The investor sees time as an ally, the trader sees time as an adversary. The investor's lens, patience, value, and compounding investing is long-term by design. The goal is not to predict where price will move tomorrow, but to position capital so that over years and decades, it grows through compounding, the steady reinvestment of returns that magnifies wealth over time. Characteristics of investing time horizon, multi-year, often measured in decades. Generational wealth is the archetype. Focus fundamentals, cash flows, innovation, macro trends, and long-term resilience. Strategy, diversification across asset classes, holding through cycles, reinvesting dividends or yields. Strength, patience and conviction through drawdowns. Risk, underestimating structural change, e.g. clinging to dying industries or mistaking speculation for value. An investor buying a broad index fund does not care about next week's central bank meeting. What matters is that broad indices are designed to trend upward over time as new winners replace old losers. This is sometimes called the always up effect, not because prices never fall, but because the system's construction creates upward drift across decades. I discuss this concept in more detail here. For the investor, the essential question is, will this asset be worth more 10 years from now? The trader's lens, precision, timing, and adaptation. Trading is different. Here, time is not an ally but a constraint. Each position is a hypothesis about short-term price behavior, and success depends on entering and exiting at the right moment. Characteristics of trading time horizon, seconds to weeks depending on style. Focus, price action, volatility, liquidity, and order flow. Strategy, tactical, rules-driven setups with strict risk management. Strength, flexibility and speed of adaptation. Risk, overtrading, emotional decision-making, and death by 1,000 small losses. The trader does not ask, will this company exist in 10 years? They ask, where will price likely move in the next hour? And can I enter with enough precision that my risk is smaller than my potential reward? If investing is about tending orchards, trading is about fishing in fast-moving streams. Both can yield sustenance, but they demand entirely different temperaments. Complement or conflict. To frame trading and investing as opposites is misleading. They are not mutually exclusive. Many seasoned market participants do both. An investor, for instance, may choose to keep the majority of their wealth, say 80%, in long-term holdings that grow steadily over decades while allocating a smaller portion to short-term tactical trades. A trader, by contrast, might take the opposite route, using the profits earned from quick movements in the market to build a more stable foundation of long-term investments. The danger lies not in combining the two approaches, but in confusing them. An investor who reacts to every market fluctuation like a trader risks undermining the very compounding they rely upon. Likewise, a trader who clings to losing positions with the patience of an investor often misses crucial exits and allows small setbacks to snowball into larger losses. The discipline of markets begins with clarity, knowing which game you are playing and committing to its rules with coherence and consistency. The time frames of trading. Not all traders are the same. To call someone a trader without context is to miss the most important question: over what time frame? A scalper operating on the 1-minute chart has almost nothing in common with a position trader who holds for months. Their psychology, methods, and risk tolerances diverge so drastically that they might as well be playing different sports. Yet they share a common language: price, risk, and probability. Let us walk through these time frames, from the most intense to the most patient, to understand their unique demands. Scalping, the razor's edge time frame, seconds to minutes. Objective, extract tiny profits repeatedly, relying on volume of trades rather than size of moves. Environment, thrives in highly liquid range-bound markets with tight spreads and predictable micro-movements. Discipline, flawless execution, quick reflexes, and emotional neutrality. Scalping is the most extreme form of trading. It involves opening and closing positions within seconds or minutes, aiming to capture the smallest possible price movements. A scalper might place dozens or even hundreds of trades in a single session. The scalper is not concerned with the story of the market. They care about order books, spreads, liquidity pools, and millisecond reactions. In crypto, this often means living inside perpetual futures markets with deep liquidity. In equities or forex, it means working at the speed of electronic trading. The edge lies in precision. Even the slightest hesitation can turn a winning scalp into a loss. And because profits per trade are small, costs matter. Transaction fees, slippage, and spreads can easily overwhelm gains if execution is sloppy. Scalping is seductive for beginners because it feels active, fast, and exciting, but it is also the most punishing. Very few traders have the temperament to sustain the focus and emotional detachment it requires. One mistake can wipe out the gains of an entire session. Day trading, the rhythm of a single session, time frame, intraday only. Objective, capture directional moves or multiple swings within a day. Environment, best in markets with strong intraday volatility, news catalysts, macro events, or well-known daily liquidity cycles. Discipline, patience to wait for setups and flexibility to cut losers without revenge trading. Day trading is more measured. Here, the trader opens and closes positions within a single day, never carrying risk overnight. Positions may last minutes or hours, but by the closing bell in traditional markets, or by the end of a chosen session in crypto's 24/7 world, all trades are closed. Day traders often rely on technical setups, momentum bursts, and intraday patterns. They might fade liquidity at the open, ride volatility during major announcements, or exploit predictable cycles, such as funding rate flips in crypto. Unlike scalpers, day traders can afford to wait. But the trade-off is pressure. Because all positions must be closed by day's end, missed entries or hesitation can mean missing the only opportunity of the session. The danger of day trading is psychological. The intraday environment is noisy, and traders often overtrade, mistaking randomness for opportunity. Discipline here is not just about entry and exit, it is about knowing when not to act. Swing trading, patience within ranges, time frame, days to weeks. Objective, capture swings between key levels in range-bound or cycling markets. Environment, thrives in markets that spend most of their time consolidating, which, as Wyckoff taught, is the majority of market life. Discipline, patience to let setups form, conviction to hold for days, and clarity to exit without greed. Swing trading sits between the intensity of day trading and the long patience of position trading. Trades last from a few days to a few weeks, aiming to capture medium-term swings between support and resistance. Swing trading is perhaps the most practical and accessible time frame. It recognizes the structural truth that markets spend far more time ranging than trending. Expansions are brief, crescendos that quickly exhaust themselves. The range is the rhythm. A swing trader might buy near the bottom of a range, sell near the top, and repeat. They might also ride medium-term trends, but always with an eye toward reversion. In crypto, for example, this might mean holding a position for 5-10 days across funding cycles or market maker accumulation zones. The gift of swing trading is balance. It requires neither the frantic speed of scalping nor the near monastic patience of investing. But it is not without danger. Overconfidence during ranges can lead to stubbornness, and holding through weekends or unexpected events can turn a swing into an unplanned position trade. Position trading, riding the larger waves, time frame, weeks to months. Objective, align with larger market trends, ignoring short-term noise. Environment, works best in trending markets, macro-driven cycles, sector-wide moves, or crypto bull-bear phases. Discipline, conviction to hold through volatility, and humility to exit when the macro shifts. Position trading is the longest time frame within the trading spectrum. Positions last weeks to months, sometimes longer, aiming to capture large structural moves. Position traders begin to resemble investors in their patience, but with one crucial difference. They are not wedded to assets forever. A position trader may hold Bitcoin through a halving cycle, but exit when liquidity dries up, while an investor may continue holding regardless of cycles. The challenge of position trading is twofold. 1. Avoiding premature exits when noise shakes conviction, and 2. Knowing when to leave before the trend collapses. This requires an understanding of cycles, liquidity flows, and macro structure, themes we explored in The Invisible Balance and the Depths of the Market. Choosing your frame. Each time frame has its own demands. Scalping requires intensity and split-second decision-making. Day trading requires adaptability and emotional discipline. Swing trading requires patience and balance. Position trading requires conviction and macro awareness. The question is not which is best, but which fits me. Your lifestyle, stress tolerance, and schedule matter more than the strategy itself. A trader with a full-time job cannot realistically scalp. A retiree with patience might thrive as a swing or position trader. Ultimately, consistency comes not from choosing the perfect time frame, but from choosing one aligned with who you are. The trader's home ground. One of the most overlooked truths in trading is this: markets spend most of their time moving sideways, not vertically. Expansions, those dramatic surges and collapses that dominate headlines, are the exception, not the rule. The rule is the range. A range is where price consolidates, oscillating between support and resistance, creating the appearance of stasis while beneath the surface accumulation and distribution take place. Traders who recognize this rhythm can thrive. Traders who chase only breakouts often find themselves bleeding capital, buying tops and selling bottoms. Why ranges matter? Ranges are not dead time. They are the hidden heartbeat of the market. They matter for three reasons. Liquidity pools form in ranges. Every consolidation builds liquidity on both sides of the range. Stop losses gather above resistance and below support. Market makers know this. They engineer liquidity hunts, false breakouts designed to trigger stops and harvest liquidity before returning price back into the range. Predictability creates edge. Unlike chaotic expansions, ranges provide clear levels to trade against. Buy near support, sell near resistance, fade false breaks, exploit mean reversion. It is in these repeatable structures that traders can systematize edge. Accumulation and distribution. As Wyckoff mechanics teach us, ranges are where institutions accumulate positions before markup or distribute holdings before markdown. Understanding the language of ranges allows traders to align with, or at least avoid fighting the smart money. Trading styles in ranges. Different timeframes interact with ranges differently. Scalpers exploit micro moves within the range, entering and exiting multiple times. Day traders play range-to-range moves intraday, fading liquidity hunts or riding volatility from one boundary to the other. Swing traders often thrive most here, holding positions for several days as price oscillates between levels. Position traders use ranges to identify macro accumulation zones, entering early in anticipation of the eventual breakout. This layered interaction is what makes ranges so central. They provide opportunities across every time frame. The danger of expansions. It may seem paradoxical, but most traders lose money in expansions. Why? Because volatility without structure is deceptive. False breakouts. Traders pile into breakouts only to be trapped as price reverses. Slippage and costs. Rapid moves widen spreads, making precise entries and exits nearly impossible. Emotional traps. Big moves trigger fear of missing out, FOMO, leading to poor decision-making. Expansions reward those already positioned, not those chasing late. The consistent edge lies in recognizing the range before the move, not in reacting to the move itself. Discipline in ranges. Trading ranges requires a specific temperament, patience, waiting for price to come to you, not chasing every tick. Humility, accepting that most breakouts are traps until proven otherwise. Clarity, defining in advance what invalidates your trade. This discipline is deceptively simple, but profoundly difficult. Ranges lure traders into overtrading because the market appears quiet, but it is in the quiet that the stage is set for the next act. The range as rhythm. Think of the market as music. Expansions are the crescendos, loud, brief, and dramatic. Ranges are the rhythm, steady, patient, the structure that makes the crescendos meaningful. To thrive as a trader, one must learn to dance with the rhythm of the range. Recognize that the sideways is not wasted time, but the essence of the market's movement. The range is not a distraction, it is the home ground. Conclusion. The discipline of horizons markets seduce us with the illusion of constant opportunity. We imagine that if we are clever enough, disciplined enough, or brave enough, we can catch every wave, time every move, and harvest profit wherever it appears. The temptation is to believe that the market is a puzzle waiting to be solved. But the truth is far more humbling. The market is not a puzzle, it is a mirror. It reflects our discipline, our impatience, our greed, and our fear. At best, we do not master the market. We master ourselves within it. Two different relationships to time. The difference between investing and trading is not simply a question of strategy. It is a question of time and how we relate to it. The investor allies with time. Decades are their raw material. They let compounding, reinvestment, and structural growth do the heavy lifting. Their edge is endurance. The trader wrestles with time. Minutes, hours, and days are their battlefield. They rely on precision, timing, and adaptability. Their edge is agility. Both can be successful. Both can fail. What matters is not which path is better, but which aligns with temperament and horizon. To invest with the twitchy impatience of a trader is to sabotage compounding. To trade with the passivity of an investor is to miss exits and court ruin. The fractured spectrum of trading. Even within trading, horizons fracture further. Scalpers carve seconds. Day traders ride intraday tides. Swing traders live inside ranges, capturing the middle ground. Position traders align with larger cycles, holding for weeks or months. Each style is a discipline of time. Each rewards a different psychology. What unites them is not method, but the demand for coherence. To know your frame, to respect its limits, and to avoid drifting into a game you are not prepared to play. The centrality of the range across all horizons, one truth endures. Most of the market's life is spent in ranges. Expansions are brief, dramatic crescendos. Ranges are the steady rhythm, the place where liquidity builds, where patience is tested, where smart money accumulates or distributes. Expansions generate headlines. Ranges generate edge. The disciplined trader knows this. They do not chase the noise of vertical moves. They learn to dance with the sideways, to respect its boundaries, to wait until the rhythm resolves into a new crescendo. Clarity of horizon. The final lesson is not technical but human. It is clarity of horizon. Know whether you are investing or trading. If trading, know which time frame you are inhabiting. If investing, know what decades of conviction will demand of you. Confusion of horizons is the silent killer. The investor who panics like a trader destroys compounding. The trader who holds like an investor is trapped in positions they should have abandoned. The range punishes those without patience. The expansion punishes those without humility. The discipline is not about predicting the future. It is about choosing the game you are playing and playing it with coherence. A final word. Because in markets, as in life, the greatest danger is not choosing poorly. It is drifting without choice at all. Clarity does not guarantee victory, but it does guard against ruin. And sometimes in a world of uncertainty, that is the edge that matters most.